I don't know, but I would say that silver certainly is likely to have a huge, great squeeze at some stage, and that's the metal I would put my money on for a repeat of the nickel situation. It wouldn't surprise me at all if we have another nickel event, and I would have thought that the commodity which is at greatest risk of that is probably silver. What we see is silver is probably the most important metal for this new electronic age, you know, with solar panels, with the electrification of transport, I mean, the whole thing. Silver is desperately important. When you look at the price of lithium, how that's shot up, the price of uranium, how that's shot up. I'm talking about non-fossil, commodities involved with the non-fossil environment. Silver has been very much left behind. And I was reading something sent out by researchers from, I think it was Metal Focus, that the demand for silver in India has just taken off. I mean, it's been huge in the first half of this year. And for that reason, we've seen stocks in the London vaults have been declining. So, yeah, I mean, there's no physical around. I think generally that is true to say. So you've got a situation where, if I was a bullion bank, I would want to get an even position or even a slightly long position under those circumstances. And I'm sure that, at some stage, particularly if this thing, if we get a systemic crisis, which in the banking system, I think is beginning to be recognized as a real likelihood again, then, what do you want to do? I mean, if you can't get your gold shorts back, then, you might be able to defray the loss a little bit by having a long silver position. And to my mind, I think that it is quite likely that silver could have that sort of spike. Now, having said that, the LME has, I think, stopped dealing in silver. I haven't looked recently, but I read somewhere that they've stopped dealing in the precious metals. LME precious is being closed down. So there are two things I think we need to take on board. The first is the obvious one, and that is that the interest rate environment has changed completely. From about 1980, interest rates have been in a long-term decline trend. And that ended with the Fed at zero. It ended with the ECB at -0.5. It ended with Japan at minus whatever it got down to. Japan is still there, asleep at the switch. The ECB is just waking up a little bit. The Fed is already moving rates up, and we're going to get another meeting, I think this week, aren't we? This is being recorded, on the 26th? So, yeah. And the Bank of England has woken up a little bit as well. The fact of the matter is that interest rates, official interest rates in the region of 2%, are way behind the curve. We've got inflation rates measured by the CPI in the region of, closer to 10%, basically. And we've got the RPI here, which was discarded some time ago because it was costing the government too much in indexation. So they swapped it for the consumer price index, but that's now running at 11.8%. That's an official inflation thing. So to have a bank rate at around about 2%, I mean, it's a broken market in effect. What they're doing is they're saying that, if we can just ride this out, it'll come back to 2%. The reason we got such high inflation is that, first of all, we had the problems with supply chains, and now, of course, we've got this Ukraine situation. But Putin's bound to lose that one, and then everything will return to normal. This is wrong. I mean, I was looking at our official statistics and forecasts here, and they're still talking about it going back to 2%. CPI back to 2%. So that's if you like, the first thing. The second thing, which I think is also part and parcel of this problem, is something that Jamie Dimon said at a banking conference at the beginning of this month. He stood up and he said, a couple of weeks ago, I said that the economy was facing storms. I'm upgrading that to a hurricane. We face a hurricane. That's what he said. Jamie Dimon was saying something terribly important, and that is that at the margin, JP Morgan is going to reduce its outstanding bank credit, because his message was basically there is too much risk for a bank which is highly leveraged. We do not want to get caught out. We do not want to get caught out with counterparty risk. So coming back to what you're saying about gold, look, I think Jamie Morgan is in, if you like, a mode to sort of start shutting down a lot of JP Morgan's operations. I mean, obviously, as the Fed's main channel into the US banking system, there's not a lot he can do in certain respects. But I'll tell you something else, and that is that any other banker, because they all work as a cohort, they all think the same way, they all have the same problems. Any other banker who has not already worked out that he should reduce the outstanding bank credit that he has in the market on his balance sheet will certainly have noted what Jamie Dimon said as the leading commercial banker in the world, and will now be very seriously thinking of doing so. Now, what does that do? It means that banks basically call in loans. We've already seen them, if you like, reducing the outstanding loans backing speculation in financial securities. I mean, if you look at the NASDAQ figures for margin debt, I mean, that's come down quite sharply. It's still very, very high. It's got a long way to fall. You'll see them basically freeing up their balance sheets where they can. And a lot of that will be turning around to companies who have overdrafts and saying, we're not going to either not going to renew your overdraft facility, or we're going to reduce it. Now, so what does that do? It means that companies which don't make enough money to cover their expenses are going to have to start cutting quite hard. So what we're looking at is a situation where rising interest rates, through the effect of contracting bank credit, is going to contract GDP, because GDP is no more than the sum total of credit in the economy. That's it. That's what it is. It's no more than that. That the thing that really matters is what's going to happen to bank credit. Banks are highly leveraged, and they're particularly highly leveraged in the Eurozone and also in Japan, where their leverage is over 20 times on average. And if you look at the Eurozone, the worst is Group Crédit Agricole at 27 times assets to balance sheet equity. And you look at the share prices of these banks, they are all standing at massive discounts to book value. What does that tell you? It tells you that the market's saying that these are not good investments, they are unsafe. Normally what you would do is you would try and buy things which are cheap because they are close to book value. This is deep discount to book value. This is not good news. We have a banking crisis on the way. When this one happens, when this one blows, it's going to be far bigger than what happened back in 2008, 2009 with the Lehman failure. This is a very serious situation which we face.